Good afternoon, good morning, good evening, everyone, depending where you are, and welcome to today's Future of Financial Information webinar. So my name is Michał Dziewiński, and I'm the host of this series. And today it's my great pleasure to welcome Clifton Green from Emory, our speaker, and Marina Niessner from Yale, our discussant. And today's topic is something you've probably all noticed in the stock market over the past year or so. Some spectacular and sometimes strange things going on. And so today we will take a look at the actions of the traders who are presumably behind these developments. So just a little bit of housekeeping. Clifton will present for about 30 minutes, and then Marina will follow with her comments for about 15 minutes, and we will have a live Q&A session until the 1 hour mark. But don't sit on your questions necessarily until then. Feel free to post them in the chat. I will be keeping an eye on the chat throughout the webinar, and then I will make sure to get back to your questions if they're still unanswered. And on this last part, so actually all three of Clifton's co-authors on this paper are with us today. So chances are high that if you put your question to the chat, you'll get an answer there straight away from one of them. So without further ado, Clifton, the screen is yours for 30 minutes. And thank you for being here.
Thank you so much. This is the first time we're presenting this paper. It's it's really fresh. And a PhD student presented their proposal yesterday. And he said this is the first time he was presenting it, so he valued our comments. And it made me think, would you not value our comments the rest of the time? And so I would value your comments anytime, but they are especially helpful since we are still thinking through this, and it's still very much a work in progress. So thanks for this opportunity. And I look forward to your comments and also, of course, Marina's thoughts as well. We study Robinhood investors. There's been a trend towards lower and lower commissions over time. This is from the 80s. It's been going down gradually. The gray is commissions, and it's like dollars per share. So it's not exactly the way that we're thinking about it, but obviously it's been a long trend that this has been happening. But Robinhood is special in a couple of ways. They're free is special, not just $1 to trade or $5 to trade, but $0 to trade seem to be very salient to potential investors. They also have a lot of other stuff like no account minimums and an easy to use, very streamlined app. You can trade fractional shares, so you don't need $3,000 to buy Amazon. And there's this other aspect that I hadn't thought about so much at the time, but I think may play a somewhat a decent sized role in their success and growth. And that is this gamification idea. They have a lot of these elements like that when you sign up for an account, you get to scratch off like a lottery ticket, and then they give you a share in a stock. And it's one of 400 different stocks that they pick. It can be Facebook, it can be like a $100 stock, or obviously most likely it's a $3 or $5 stock. But this seems to have really, the architecture of the platform has lured people in and made them want to trade. And so they've had a lot of growth, and now they're on the same order of magnitude as Schwab in terms of number of accounts, and they're bigger than E-Trade in terms of their investor base. So who are these investors? They tend to be younger and less experienced. The median age is 31. 78% of them are under 35. In our analysis of web traffic that we've done ourselves, looking at Alexa Internet and SimilarWeb, we looked at their frequently asked questions page on Robinhood and some others, retail brokers, and they tend to be more basic, like what is the stock market, what is the S&P 500, whereas the other brokers will ask a little bit more sophisticated things like what are calls and puts and those kinds of things. So the size of the accounts are small, in the order of $1,000 to $5,000, compared to considerably bigger for the other brokerages. But despite their small size, they trade a lot. So they trade 40 times as much as Charles Schwab's investors based on how much the size of their accounts. And so they do seem to be active investors. And so in our title and throughout the paper, we call these zero commission investors. But in practice, of course, most investors nowadays are paying zero commissions. All of the other brokers, not all of them, but many of the other brokers have lowered their commissions to zero following suit with Robinhood. So when we say zero commissions, we're referring specifically to this new type of equity market participant that's been lured to financial markets because of these features that Robinhood has. Okay, so what about these investors? Are they, we know they're not super sophisticated. They seem a little more in line with the traders that Barbara Odeen studied from the 90s. This is a survey paper, but of course they have quite a few papers in this area. However, there is recent work that says that retail investors tend to be informed in aggregate, and that it predicts returns over the next week to month, and it predicts earning surprises and those kinds of things. There's quite a few papers in recent years that look into this topic. I am myself one of these et als in this paper here, the Farrell paper. We look at Seeking Alpha research days and find that the retail order flow is incrementally informed on those days. And so in our analysis here, it's not our primary research question, but we start by looking at the performance of Robinhood investors. So there are a couple of contemporary papers on this topic, so I'm just sort of nested in what has been done already. But let's start by talking about where we get the data. And when you go to the platform for Robinhood, one of the features that you can see, or used to could see, was the number of owners. So this is, if you type in a ticker symbol, it would tell you the number of Robinhood owners that own the stock, and they would update this once an hour. And so my co-author, Yanbin, noticed this in 2018, and he built a robot to start scraping the data from Robinhood. And we started playing with this data in 2019 and contrasting it with other measures of order flow, of retail order flow. And then we were so excited during the pandemic when Robinhood got super interesting, but then someone else did the same thing. So a random person, not an academic, also had scraped the data and posted it to the internet on a website called RobinTrack, which sort of killed our first mover advantage, but made it much, brought the samples available to many more people. And so he stopped tracking it. We just started getting it from RobinTrack. But I want to give him credit for having the idea of scraping it himself. So this is the data that we have, is hourly changes in the number of, so it's breadth of ownership data. It's not trading per se, but it's just how many investors own the stock on an hourly basis. So Welch has studied this in aggregate, so not trades per se, but aggregate ownership for all of the investors. And he finds some evidence of savviness. I think this is in part due to them buying here. Like maybe you remember from the stories at the time that when the market tanked in March, retail investors piled in, and then that made them look really smart because it came back. And but they don't just buy on downturns. They also buy when the price goes up a lot. And so this is just the SP 500. So there's some evidence that of savviness in aggregate. But if we look at the trades themselves, this also looks at Robinhood data. Barbara Odeen, Schwartz and Shu. They also look at the sample, and instead of focusing on aggregate ownership, like which emphasize buy and hold types, they look at the trades themselves and look specifically when there's a bunch of users piling into a stock, and then they find evidence of reversal. This is like 8% reversal over the next month or so. And so this is more evidence that they're not doing so great in the informed dimension. In our analysis ourselves, what we do is do a horse race between Robinhood and the traditional retail order imbalance measure from a recent algorithm of Bomer, Jones, Zhang, and Zhang. And so we just put them in there together. So we regress weekly returns, return changes. So we look at return, well, I'll just show you. So this is returns over 3 days, over 5 days, over a month, trading days. And we regress it on weekly changes in ownership for Robinhood. And then this is the traditional aggregate retail trading measure from Bomer, Jones, Zhang, and Zhang. This is out of sample, I think. It's pretty much out of sample from their study, but we continue to find the positive relationship between returns, between order imbalances, retail order imbalances, and returns. However, when we look at Robinhood investors, we find no relation. And if we do percentage change, we actually get some negative stars in a couple of places. So our takeaway from this analysis is that the stock level trades of Robinhood investors are generally uninformed. There's no evidence like this recent evidence suggests that retail investors are informed in aggregate. We're not seeing that with our Robinhood investors. When they trade, it doesn't seem to mean a whole lot for prices. And so then our primary research question is to then study the effects of these new market participants on market quality. So from the microstructure perspective. And so I'm going to build some tension and say that it might help things. If these investors are uninformed, then we have adverse selection models that suggest the more noise traders or liquidity traders there are, the easier it is for market makers to make markets, and spreads could be narrow and transaction costs lower. On the other hand, there's also models that suggest that noise traders may create volatility if they tend to trade in, with sentiment traders that trade in the same way, consistent with behavioral models. And also in a microstructure setting, if they create inventory risk, that can make liquidity worse when they're around. So this is what we're going to explore. One important mediating factor here in this context is the role of the high frequency traders that serve as market makers for these investors. So the way that zero commissions work, of course, is that there's payment for order flow, and HFTs like Citadel and Virtu pay Robinhood to make markets for their customers, and then that's how it works. And so the reason they're able to do this is because they offer price improvement. Of course, the story is that they're afraid, well, not afraid, but you know what I mean. So they're more afraid of institutional investors on public markets, and they quote, wider spreads, but then they feel more comfortable trading with the retail traders, so they're able to, quote, give price improvement. And so when they handle these trades off exchange. And so this is precisely the way the algorithm works for Boehmer, Jones, Zhang, and Zhang, is that they look for this evidence of price trading off exchange and evidence of price improvement, and they say, aha, that was a retail trade. And so nowadays, 47% of shares are traded off exchange, but that doesn't mean just retail. That's also institutions trading off exchange. But there's evidence of as much as 20% of total volume is retail oriented. And so this is, they're becoming a bigger, important chunk of the market. Okay, so are HFTs good or bad? How might this affect market quality? There's some evidence that suggests that, I'm peeking at the chat, but I'm happy for them to respond. There's evidence that suggests HFTs that lead to improved market quality, but there's also some evidence empirically that they can create volatility and that they may trade in predatory ways. And so in our context, maybe this noise trading may help them make markets, or it could let them trade in some, nefarious way. And so this is just from this morning, where Elizabeth Warren said that their shark Citadel preys on customers. So if they do prey on customers, then maybe the absence makes it harder for them to prey, and it can make markets better. So I'm trying to build a little bit of tension with the role that HFTs play. Okay, so how are we going to go about finding the effects of these Robinhood investors on markets? It's a challenge because the stuff they trade is endogenous with liquidity. They like liquid stocks. And so existing approaches, there's a couple of papers in Journal of Finance, one from the early 2010, I was going to say early 2000s, that's not early. So, but the law change they look at is from the early 2000s. And so they study a law change in France that led to faster settlements. There was this, some trades would settle at the end of the month, which made them sort of like futures. And it became a way that you could, it was a really low cost way to use leverage. And so retail investors would do that. And when they did away with that way of trading, it became more costly for retail investors to speculate. And they saw that changing this law improved liquidity, which is consistent with retail investors making it worse. So on the other hand, mixed evidence here, Perez and Schmidt, they use distracting US news stories, like their examples, the O.J. Simpson trial. So not something related to financial markets, but something that is capturing people's attention. And then they find that when retail trading experiences these shocks, then liquidity is lower. So two different shocks that people have studied, and with mixed evidence for how this might affect financial markets. What we're going to do in our paper is look at these platform outages. And so there are quite a few of them. This Massachusetts has their complaint against Robinhood, where they say there's maybe as many as 70 of them due to server capacity issues or hardware or software issues. So here's some tweets where Robinhood is admitting they have some problems. So how are we going to define them? Oh, it's economically relevant. So someone had, when their system was down, they took the time to make a meme here that suggests they were unable to trade. So how do we find them? We use this website called Detector, which sort of finds when various things are not working, not just financial things, but gaming, other settings. Here's an example where they'll track every 15 minutes, and when they get user complaints or they determine something happens. So there were a lot of complaints on this day. Robinhood saying, yeah, we're having a problem. The way we find them is we make them occur during market hours, and we want at least 200 people complaining. And when we use that filter, we get 25 outages during the January to August of the 2020 timeframe. The median length is 30 minutes for these things. There is data available. The RobinTrack data is available up back to 2018, but there were not so many outages then. And there were none that occurred during the day and had 200 people complaining. And so that's why we focus on this period is for the outages. So I know that you're already thinking these things may be endogenous. And so we're going to do quite a few things to help you not worry about that. But at least on the face of things, it doesn't seem like it's completely mechanical with when increases in ownership or this are changes in owners. But it's, it's like, well, it seems to be relatively spread out. Okay. So in order to study the effects of these outages on markets, we need to know what stocks they would have traded if they could have. And so our main proxy for that is WallStreetBets. And so this is also something that's been in the news a lot recently. And so as being something that stimulates trading from these types of investors. So we scraped the website for 2020 and found the kinds of things that they were talking about. And so the sample that we emphasize due to the outages is January through August of 2020. Why did it stop in August? Because that's when Robinhood realized that maybe it's not so good to make public what their clients are doing. And so they shut down that part of the website so you cannot see what their investors hold. They do continue to give a list of like top 100 or something like that owned by Robinhood, but not these hourly changes anymore. And so for our purposes, we require 500 owners on average with a minimum of 50 over the previous week of the outage for the context we're looking at. So our proxies for trading are we use quintiles, so top quintile, lots of unique posters on WallStreetBets, or alternatively, just lots of trading, absolute ownership changes, hourly ownership changes, absolute, so in and out over the past week. Okay. So first, this is just a validity check that says, does this sort of approach work? Do we find the stuff they're likely to trade? And it seems like they do. So this is at the daily level, these are days, we sort on top quintile for WallStreetBet mentions, and then we look for the next days. So day 0 suggests they were in top quintile mentions, and we see that they do trade these things for the next few days. And so our approach is to look for lagged over the previous 5-day mentions and then look, say today, this is something they would have traded. One thing that's kind of interesting from this figure is what goes on with traditional retail order flow. This is the BJZZ measure, and it suggests that they traded it last week. So if we sort today on high WallStreetBet mentions, we're picking up stuff that the other retail investors already traded. And then the Robinhood investors begin to trade it. So it seems like Robinhood investors are a few days behind other retail investors in the stocks that they're buying, which could explain some of the reasons why they're not doing so well. Okay, this is not directional. So we're just saying volume, not buying. So we could try to refine that, but currently this is just volume. So just some descriptive statistics on our proxy for stuff they're likely to trade. And we do see some differences, obviously. This is going to be our control. And so there's some concerns that these are not good controls for these, but hopefully I'm going to make you feel better about that too. So over the average week, it's mentioned 815 times before the outage, and it's traded on an hour per hour of 100 by 100 Robinhood users. And there's the percentage, and they do tend to be more liquid and bigger and those kinds of things. But okay, so our approach to identifying these differences is a difference in difference type approach, where we compare the high WallStreetBets or high lagged Robinhood trading stocks to other stocks during the outage and then relative to the benchmark period over the previous 5 trading days. That's our benchmark. And so we use, so the same time of day, it's time of day matched in this our approach. And we use our indicator variables. We got firm and day fixed effects. And so as a way to make this, try to do a out of sample check, we have a pseudo event that we measure 1 hour after the actual event. So here is the first step, which is to look at trading. And we find that trading is significantly lower during the outages by like 6% for trading intensity. And it's negative across the board. It isn't significant for the aggregate retail volume, which suggests again that they're doing a little bit something different than what BJZZ is. I mean, the other retail investors are doing other things than Robinhood. Okay, this is the second proxy. So here, our main sort of set of variables for market quality are these standard spread measures and impact measures. And we do this in the same setting as well. So here's our, these are in the neighborhood of 4 to 10% lower for the Robinhood stocks during outages, and with no significant effects during the pseudo outages. So this is the other proxy, similar stuff. So we also look at volatility and find that volatility is lower. The average, that's 240 basis points for stocks in this top quintile. And so to give you a sense of scale, but I'll give you another sense of scale in just a second. And so what do we do for robustness? We look at percentage changes in ownership instead of level of changes. This is sort of an important one, I think, potentially. Like, one concern with these outages that maybe they weren't driven by market news, but by one stock or a handful of stocks that had huge firm-specific news, like Hertz. Hertz was going bankrupt, and that got them all excited. And maybe Hertz itself caused the outage. And so we'll throw out firms like Hertz that have a big spike in WallStreetBet mentions on the day of the outage. And then that way we can study if Hertz caused the outage, we can look at the other stocks that were also affected by the outage. And so we find that the results hold in that context as well. We throw out outages during the March 2020 period when it was super volatile during the pandemic, and the results get weaker, but they hold as well. And then we do a number of other stuff. So, and it tends to work. Like I said, it gets weaker if we throw out the March observations that were super volatile, but the pattern is fairly robust. But maybe here's what you want to see the most, which is figures where we look before, during, and after. For the subset of 15-minute outages, we compare the measure during the benchmark period and standardize by the benchmark observations. And we can look at high WallStreetBet mentions or lag trading mentions versus the others. And so here's what these look like. So this is 45 minutes before. This is for the subset of outages that last just 15 minutes. There's 10 of those. So we look at 45 minutes before, and then the outage itself, and then another half an hour after that. And so, or 45 minutes after that. Was that right? Yeah, whatever. So it does seem to be a causal relationship. This is not some sort of longer trend or market news that's happening, or it doesn't seem like firm-specific news either, to the extent that we can throw those out and we still get our findings. It seems like there's a sharp impact of the outages on measures of market quality and volatility itself. Okay, so we also look at high-frequency trading measures, first broad measures that the literature has used, but also something that we do that's new, at least a little bit in our context, is to look at the lit market quotes for dealers, for NASDAQ stocks, for dealers that have these payment for order flow arrangements with Robinhood, like Citadel, Virtu, G1 Execute, et cetera. And so the caveat is that this is not all of their quotes. This is just the stuff where we can identify that they are the ones doing it, but we find that they react as well. So lower evidence of HFT activity during the outages, lower evidence of quoting behavior. Here, I'll just show you the figures. So here is the lower HFT activity, but also specifically narrower spreads for Robinhood affiliated dealers, not so much for the rest of the dealers. So if we have this, if the evidence suggests that Robinhood investors are making it worse, that these noise traders are creating volatility and inventory risk for the dealers, it's consistent with the idea that they're hurting. So they shouldn't create inventory risk if they're all trading independently, but it's when they trade together that seems to create volatility and the threat of inventory risk for these dealers. And so we try to look for evidence that they are trading on the same side of the market. So we measure imbalance and see if this changes do markets get more balanced and less one-sided when they're gone. And so we measure trade imbalance, but also depth imbalance, like how balanced the limit order book is around the inside. And evidence of that, I'm just going to show you this one. There it is. So also trade imbalances goes down when the Robinhood investors aren't there. The depth of the quotes look more balanced, and in particular for the quotes that are being provided by Robinhood market makers, the ones with payment for order flow arrangements. And so again, no strong effect for non-Robinhood market participants with their assigned quotes. Okay, so in our last bit of analysis, we try to say if this is related to inventory risk, then we might expect the effects of the outages to be stronger for stocks with more inventory risk. And so we proxy for that with this herding idea, and we get at that with autocorrelated trading over the last week. So if they tend to, how autocorrelated is the changes in users? Do they buy, or sell? And the more likely they are to be working on the same side of the market, that's going to create more inventory risk for the dealers. And so we create quintiles based on this. Descriptively, the autocorrelation in hourly changes in users is 0.19 for top quintile, compared to still fairly correlated for quintiles 1 and 4. And if we contrast that with BJZ, we get it's considerably smaller. So they do tend to be more autocorrelated than retail investors more generally. Of course, again, this is the one caveat being this is changes in users. This is volume per se. So it's not exactly apples to apples, but consistent with them being more correlated. So then we triple interact it with our existing setup. And we find that for stocks, WallStreetBets stocks or lagged activity stocks, if the stocks tend to be more autocorrelated in the past, and that has a bigger effect during the outage and liquidity gets better. So I don't have a figure for this one since it's a triple interaction, but it's consistent with there being liquidity risk. Here's the other proxy, it tells a similar measure. Okay, so I got a couple slides after this one. But we conclude that that it seems that our preamble is that they seem to be uninformed. The platform outages are associated with improvements in market quality and lower volatility, suggests that they're creating inventory risk for the HFT market makers. I showed you that concern by Elizabeth Warren that they're sharks and making hurting the investors. That could be true, so I can't rule that out. But from what we see here, it is not consistent with them. For the stocks that they like to trade and they herd in, they're creating volatility and they're making liquidity worse, not making it better. So it does not consistent with HFTs exploiting them. So there are two recent working papers that also look at Robinhood and liquidity. So I wanted to mention them briefly after we set the stage for what we are doing. And one is this Gloucester, Matos, Romelli, and Wagner paper. And they highlight that Robinhood investors tended to buy the stuff that the institutions wanted to sell. And I think that's often or largely perhaps March 2020 when the market tanked and institutions were selling and having experienced outflows that these retail investors were buying. But we'd like to point out that our results are robust. If we exclude March 2020, we're still getting negative effects on market quality. Consistent with them having a negative effect on market quality. And the second paper that's related is this Ozick, Sadka, and Shen paper. And they try to get identification by looking at home bias, assuming that you'll trade local stocks, which is probably true in part, but I think everybody was trading Tesla and everybody was trading cruise ship stocks and things like that during the pandemic. But to the extent that that works, then they look at staggered implementation of stay-at-home advisories during the pandemic and find evidence consistent with a positive effect. So they acknowledge that their evidence is weaker among high media attention stocks, and that's specifically what we are focusing on in our analysis, because those are the ones that they tend to herd into. And so we focus on intraday horizons and specifically on these high attention stocks. And we find, at least for these stocks, for the stocks that they're herding into, they're having negative effects on market quality when they're there, as evidenced by the fact that it gets better when they're gone. So that is it. I'm looking forward to the discussion and the comments from others. Thanks for your thoughts.
Thank you very much, Clifton. That is perfectly timed presentation. And now let me hand over to Marina. The screen is yours for 15 minutes. And in the meantime, just let me remind everyone that the chat is open for your questions.
1 second. Can you guys see my slides and hear me? Okay, perfect. So thank you very much for inviting me to discuss the paper. It's definitely in an area I'm very interested in, so I was very happy that I got to read it and play with some data and have a good excuse to do so. Oops. There we go. So Clifton did a really good job, not surprisingly, presenting the paper. So I'm going to, in the interest of time, do a very quick summary and then get to my comments. So there are a lot of changes that happened in the world in this past year. I think most of you are aware of what they are. And one change that we're also now all aware of is the rise of these zero commission investors or Robinhood traders. They've been sort of all over the news, especially with GameStop. And if you're ever questioning sort of Clifford's and Cawthor's assumption that these are noise traders, you can go to WallStreetBets and read some of the posts there, and I think it will become pretty clear. So given, and in the paper, they actually do show that these are noise traders. Given that these are true noise traders, this seems like a very great setting to test some theories about noise trading. So I think that's a very good idea. And more so, as Clifford mentioned, trading is, of course, endogenous. And usually we don't have good ways to sort of have exogenous shocks to people's trading activities. And here the authors, well, we all got lucky. The authors could actually write the paper, but there were, as this article title shows, there were outages, and I think most of us probably read about them in the paper, that caused, and I think the authors do a good job showing that they're more or less exogenous, which often was just Robinhood's infrastructure overloading. So of course that's not enough, because even if we have these exogenous shocks and we know that investors trade less, in order to be able to compare stocks that were affected by these outages with stocks that were not, it's important to see which stocks would have investors actually traded in. And here again, internet comes to the rescue. So Robinhood and Reddit apps were downloaded more or less hand in hand, and they do go hand in hand. I think, again, we have a lot of evidence now that Robinhood investors are very active on WallStreetBets. So I thought it was a very cool idea to use WallStreetBets post as a proxy for the trading that didn't happen. So that's the kind of main ideas behind the paper. And as the summary, again, Clifton did a great job presenting it, so I don't know that I need a long summary. So basically, I think it was, to me, it's somewhat surprising result, and I think it was to, I assume, most people who read the paper, but we usually tend to think of noise traders as sort of trading randomly, and therefore that's good for the market. Well, they actually find that when these investors do not trade, that markets happen to be more liquid, that returns are less volatile, and they propose and then show that it tends to be high frequency traders who pay Robinhood for order flow, that this creates inventory risk for market makers. So that's my summary of the paper. So first of all, in terms of comments, this is a really cool paper. If any of you are doing research in this area, I very highly recommend reading it. It uses very, very interesting and innovative, I think, data sources. And everybody else should also read the paper. So despite this paper being quite young, if you read it, it's actually very well thought out and carefully executed. If I compare to my papers at this stage, they look very different. So a lot of me reading the paper kind of looked like that every time, or almost every time. I was like, wait a second. Like 2 pages later, they had a test for that. So my comments will be a little bit more bigger picture. I'll have a little bit of nitpicking at the end. But I think I would push the authors to guide the reader a little bit more how we should think about the topic and some of their findings. In particular, I have 4 comments, but I'll probably only get to 3 of them. So first, I wanted to actually think, why are we writing or talking about Robinhood and their investors? I want to think about noise traders, retail investors, and how it relates sort of to payment for order flow. And then finally, to see whether this is kind of the new normal, what is happening with these Robinhood investors. So why are we talking and writing about Robinhood? I don't think that's surprising to anyone at this point. I think anytime we open a newspaper, there is a Robinhood article about Robinhood, and we had congressional hearings about this. And so it's definitely on a lot of people's minds. But when we think about sort of in academia, why we want to write a paper, so with Robinhood investors, there's sort of two issues. One is a bit more of a social concern. There's a lot of evidence, again, if you read WallStreetBets, a lot of these people don't know what they're doing, and so they might be losing a lot of their own money. But that is sort of not what this paper is about. This paper is about markets and the question how much these investors affect the markets. And there would push the authors to try to provide a little bit more bigger picture information on how much they actually can affect markets. And what I mean is, so I tried, obviously this data is not this data, but the data I'll show you in a second is a little bit harder to come by. And so I will only be able to show you kind of very rough estimates. But I was just very curious, how big of a chunk of the market do Robinhood investors actually make up? So first of all, how important are retail traders? And this is just, and I apologize, I think I did all the math correctly in this and next slides, but you know, take it with a tiny grain of salt. So this is Bummer's method to co-author's method to identify retail traders, and this is just the fraction of retail dollar volume over overall tech dollar volume. And as Clifton already mentions, and this usually probably underestimates it a little bit because they miss some retail trades, so it's somewhere between 10 and 20% of the market. And that's huge. I mean, whether all these retail traders have an impact on the markets is a different question, but we definitely should study this because that's a lot of trading volume. The question is, and I think Clifford and co-authors emphasize it in the paper, Robinhood investors are not necessarily like all retail traders. And so one question is, how big are those guys? So there's several, and the data is not easily available, so I was able to find some tidbits. So this is from Bloomberg, and here Robinhood actually reported for June 2020 the number of DARTs, which is daily average revenue trades. So you can think about it as number of trades. So Robinhood, if you do the math here, had about a third of overall trades compared to if you add up all the competitors. That's a really large number. That is a lot of trading. And if you just did the math, if you assumed all trades are the same, then that would account for 33% of retail volume and 4 to 6%, depending how you think about it or how you do the math, of overall trading volume. That is a lot of trading volume. One issue is, of course, that not all trades are the same. So some trades are small, some trades are big. And this is a screen from actually my personal account on Robinhood that I opened to discuss the paper. So if you can't see through all the confetti flying around because I made a purchase, I put in $1 in GME. It's worth $5 now, so I'm rich. But basically, this is the whole point of Robinhood. They are meant to attract people who want to make small trades. So I was able to find a different number, which is, so this is from Business of Apps website, but they actually do cite reputable sources. So these are estimates. Nobody obviously knows the exact number, but it does seem to be from some things that Robinhood reported to be within at least a ballpark. So in 2020, they had $350 billion of transactions, which is more than twice from what they had in 2019. And as you can see, it's been increasing. So that's a lot of billions. I tried to do the math, what fraction of overall trading that actually makes up. And so from TAC in 2020, the total retail dollar volume was 13,000 billions, just to put everything in billions, and the total dollar volume was 143 million billions. So if you do the math, so Robinhood investors make up about 2.6% of retail dollar volume and 0.24% of overall dollar volume. That is not negligible for sure, especially given the fact that these are very small guys. But I would push the authors to provide some kind of maybe back of an envelope calculations, and also then to relate how much that can actually affect the market, because these are very, very small guys. And then one thing that I actually found surprising, so I looked at 2019 data, and even though they do have fewer than half the amount of dollar volume trading, there was less trading overall in the market. So the retail volume was only half the size, and even the overall dollar volume was a significantly amount smaller. So the Robinhood investors don't actually make up that much small of a percentage in 2019. I know we all focus on 2020, but I would actually, and I'll tell towards the end of the discussion another reason, but I would push the authors to include 2019 in their analysis. I think that will add a lot of power, and also I'll revisit that again in a second. Another point that I wanted to talk about is sort of noise traders, retail investors, and payment for order flow. So the authors, and Clifton talked about it, they talk about their different theories that predict how noise traders, what effect they have on the markets, and they sort of pitch the theories a little bit against each other. Well, so I was trying to think about it, and I think, again, I would push the authors to kind of help the reader think through this a little bit more. So before we had institutional investors and we had retail investors. And when the theories were written and a lot of our research was written, this is kind of what people thought about the world. And these were the smart guys and these were the dumb guys. So that was pretty straightforward. Now we have institutional investors, we have retail investors, but then we also have these new guys that are, so now what do we have? We have kind of smart, dumb, and dumber. So how do we, I would push the authors to help a little bit think through how do we think about sort of the role of retail investors in terms of noise traders versus these Robinhood investors? In particular, among retail investors, there are definitely some not so sophisticated people as well. So are some of them good for liquidity and some of them bad, in particular because a lot of the results that the authors find here are not necessarily, and this is kind of what theories we're writing about, they're not, and hopefully I understood the paper correctly, they're not just about noise traders. Part of the reason why what we observe, what the authors observe, what they observe, is because of this payment for order flow, which is a little bit different, that's different than just having regular markets and noise traders. So I guess one question would be, if we had just regular retail investors that are not through Robinhood and payment for order flow, would we see the same effects? So again, I would push the authors to just help the reader kind of think through these things a little bit more. So the last comment I wanted to talk about, and this is where my 2019 comment will come in. So is this the new normal? So Robinhood investors are most likely here to stay in some form. I was shocked, so there are 13 million Robinhood accounts just in the US, and there are only 88 million people between age 25 and 50. So they already saturate the market quite well, but I mean, they can go internationally, so they're definitely going to be more Robinhood investors. So what about market conditions? And as Clifton mentioned already in the presentation, but the past 2 years did not look the same all the time. So there was definitely, and this I realized actually yesterday was the 1 year anniversary of the market just completely tanking last year. So obviously in March and early April, there was a ton of volatility. And this is obviously not what markets look like, hopefully. They're definitely not what markets used to look like, and hopefully that's not what they'll keep looking like going forward. I was actually happy Clifton did show that in the presentation, and I wanted to go back to that just very briefly. So first of all, I will applaud the authors to actually showing the result and not just saying that the results are quantitatively similar, which usually happens. And as Clifton, they ran a bunch of robustness tests and all of them worked out. Excluding March 2020 did work out, but I would just like the authors to spend a little bit more time talking about it. Because, I mean, we definitely see in some cases in the statistical significance goes down, but also the magnitude goes down. Of course, I understand that the numbers like return volatility is going to be a lot lower outside of March 2020. And I apologize if I missed it on the paper, but I would suggest that the authors actually show some summary statistics outside of March 2020, so it's easier to interpret the results, just to see whether the magnitudes are at least in the same ballpark. And also address, again, it's not just even about statistical significance, but in some cases, the magnitudes just changed a lot. And again, I would like to kind of be able to tell whether that is how big of an effect that is, partially because, again, I think this is an important paper, but it needs to be more than just about March 2020. And that's partially why I would recommend that they use 2019. I think some of the issues could be just power related. Well, in 2019, I looked, there was definitely some outage, not as many as 2020, but that definitely will give the authors more power, and also during a time period that's a little bit more sort of stable. So let's see, I'm almost out of time. The only thing I wanted to mention very quickly, and then I'll conclude. So in the table where they show that trading volume goes down during outages in the Robinhood highly visited stocks, aggregate retail volume actually didn't go down statistically significantly. So, and Robinhood investors are part of these aggregate trading volume. I would just like to push the authors a little bit more to tell the reader what's kind of going on there. In particular, I had my own theory, and the authors could test if it's right or not. So it could be that Robinhood investor, if like GMA is skyrocketing and some of these guys have alternative brokerages that they were invest with, sorry, they might just, maybe if I am also with Charles Schwab, I'll just go to Charles Schwab to trade. So, and the way I think, oops, sorry, the authors could test it, they could do two things. Once they could split by how long the outage was. If it was like 30 seconds or 15 minutes, maybe I'm not going to go to Charles Schwab, but in March, they couldn't trade for a day. So of course there, like you would be very upset. And also they could look at return volatility right beforehand. If there's not much happening, I might not care if I can trade with Robinhood, but if my value of my stocks is dropping very fast, I might try to do offsetting trades in a different brokerage account. Okay, so I'm out of time. So this is a very interesting and thought-provoking paper. I definitely, and again, the data and the amount of work that went in there is phenomenal. I would just push the authors to give a little bit more bigger picture and to make sure that we can really sort of external validity, that we can really apply or have these results still outside of kind of the very volatile area. And I mean, that's an area I'm just fascinated and and definitely not on this paper, but to kind of think about how these noise traders relate to retail investors and if we now just have different types of stupid investors, et cetera. So thank you very much. That's it.
One comment, well, a couple of things. One is perhaps just this notion that could they make things better in certain stocks and worse in others? Maybe it's helpful to think, or maybe we should change the title, but to say these are not just zero commission investors, but Wall Street bet investors. These are the ones that are getting excited and trading in the same way in certain stocks. Because if they do trade independently and they're uncorrelated, then it should make it easier for the market makers to make markets, not harder. And so we're specifically focusing on these times when they trade in the same way, or the stocks that they tend to trade in the same way. And this is where they're creating this inventory risk. And so we're not, it's a good point that we're not looking at the universe of all Robinhood investors. We're focusing specifically when they tend to trade and when they herd. And so that's an important distinction. And so some of the other comments, what your point, of course, about March is important. I mean, my only defense is to say that I think it matters less for our analysis than these other current working papers that also look at Robinhood. And so I think all their results will go away if they get rid of March, and just some of ours go away.
No, for sure. I think Barbara and Odin, they literally just look at March and whatnot. I completely agree with that. Yeah.
And so, but then, I mean, other things you've just given us to think more about, like we have thought about why doesn't BJZZ volume go down during the outages? And we have stories, but right now we're sort of more questions than answers along that. But it's, thanks for pointing out that it's important to think through more carefully and see if we can test for something. But now I'll open it up for anyone to make comments or questions or to add on to what Marina said.
That's right. Yes. First of all, thanks to Marina for the discussion. Thank you very much for this very insightful but also entertaining webinar. We're, or Clifton at least, going to hang on for a little while for some more informal chat. For everybody else who needs to take off, just a reminder that in 2 weeks we will be back live with our next event, Jinfei Sheng from University of Southern California, talking about risk disclosures in fund prospectuses and what can we glean from them. Okay, see you next time, or see you in the chat room.